Welcome to Talk Tickers, where we break down the earnings calls that really matter. Today, we are diving into a real head-scratcher from Best Buy. They just posted one of their best quarters in years, but the market? Well, the market decided to sell the stock. We're going to figure out exactly why.
So here's the central mystery we're unpacking today. Best Buy comes out with its best comparable sales growth in 3 years, and it beats what all the analysts were expecting. And what happens? The stock goes down. The big question is, why?
And when you look at the numbers, the paradox just gets clearer. On one side, you've got the beat. Adjusted earnings were 6 cents higher than Wall Street wanted, and revenue beat by over $200 million. But then look at the reaction. The stock dropped almost 4% on trading volume that was more than double the average. The market was not cheering, it was heading for the exits.
Okay, so to understand that reaction, we've got to first appreciate just how solid this quarter really was. The headline number that everyone looks at is comparable sales growth, and it came in at a positive 1.6%. Now that might not sound huge, but it's a major turnaround, and the best they've done on that metric in 3 years.
You know, the story of this quarter is really about building momentum. It got off to a kind of slow start in May, but then things just took off. Sales growth jumped to nearly 3% in both June and July. A big part of that was their Black Friday and July sale, which was a huge success.
So what was selling? Well, it was a powerful mix. The new Nintendo Switch 2 launch was a blockbuster, and it just supercharged their gaming category. Computing kept its hot streak going, selling more laptops than any second quarter in 15 years. And get this, even mobile phones, which had been struggling for ages, grew for the second quarter in a row. All this was happening while their online sales just kept climbing, now making up about a third of their entire domestic business.
Of course, it wasn't a perfect quarter. They definitely saw some softness in those big-ticket items like home theater and appliances, the kind of stuff people hold off on when they're worried about the economy. And tablets were down, but honestly, everyone saw that coming. They were up against a massive iPad launch from last year, so that comparison was always going to be tough.
So, that strong performance was the good news. That was the quarter that was. Now we get to the heart of the mystery, because the market's anxiety wasn't really about the past. It was all about the future.
And here it is, straight from the CEO, Corey Berry. After delivering such a strong quarter, the company decided not to raise its forecast for the rest of the year. Now, in the world of investing, that is a huge signal. It tells the market that even though things look good now, management sees potential trouble on the horizon. And that trouble has a name: tariffs.
And this tariff threat is very real, all because of where Best Buy gets its products. Now, they've made incredible progress here, slashing their reliance on China from over 55% just a few months ago. But as you can see, about a third of their stuff is still coming from there. And that lingering risk is exactly what has investors so nervous.
And the result of all that caution is right here in their full-year guidance. Even after smashing expectations in Q2, they refuse to raise their targets for the year. To the market, when you score a big win and then just stand still, it looks like you're taking a step backward. That lack of an upgrade was basically seen as a downgrade in confidence. But look, it's not all about headwinds. Best Buy is making some really smart long-term moves, like launching its new online marketplace. This could be a total game changer, letting them sell way more products and opening up brand new ways to make money with higher profit margins. But that's a story for the future. It's not a solution for today's tariff problem.
So, where does this all leave us? What's the right move? Well, here's our verdict. We call it the next call.
First off, for the third quarter, we're predicting more of the same, low single-digit comp growth, which is right in line with what management has been hinting at. Because of that, we see the stock basically trading sideways, stuck in a tight range until the market gets some real clarity on tariffs and how the holiday season is shaping up. All of this leads to our rating, market perform. Simply put, the company is executing really, really well, but these big macro issues are acting like an anchor on the stock. So, when you boil it all down, what's the one thing you absolutely need to take away from this? It really just comes down to this. The story of Best Buy right now is a battle, a tug of war. On one side, you have fantastic execution, smart new ideas, and exciting products pulling the company forward. But on the other side, you have these powerful external forces, worries about the economy and trade policy, creating a massive headwind. And for right now, that headwind is winning. And that's our breakdown of the Best Buy paradox. And as always, please remember, this is not financial advice.